I've had some people ask me about the ETFs that I have chosen to use for some of my investments. So I'm going to take some time and talk about a few of them. And I'm going to start with AIPI, which is one of my favorites. AIPI is put out by Rex Shares, and we'll just jump right into it. So AIPI stands for AI Equity Premium Income. So the AI comes from here, the P here, and the I here. That's where you get the AIPI. So the first thing I want to talk about is the distribution rate, which is the yield, or something I call dividend. This is payable on an annual basis. It's 34.8%. So let's just say 35% about. So this is based on the most recent month that the payment is made. So you'll see some of these yields will say anything from, I guess, maybe from 0 to like 100%, but they're based on typically the previous month. So you gotta kinda look at how they've done for the past several months to get the actual annual yield. But the thing I like about AIPIs is that it's very consistent. It pays about $1.50 per share per month, which comes out to be 35% for the year. The objective is that it actually owns AI stocks, and then it writes covered calls on some of those holdings, and that equals enhanced income potential. So that's how they're able to kind of predict and pay out 35% per year. They're writing these covered calls, and they kind of got an idea what the premium is going to be, how far out, and I'm sure they hold money back, or they might dip into the net assets to pay out the consistent $1.50 per share. So this keeps scrolling down. The objective is capital appreciation plus current income. So it's trying to grow the fund along with paying out a monthly dividend. Let's jump up to this other tab I got open for a minute. This website's called totalrealreturns.com. And I plugged in three ETFs, SPY, QQQ, and AIPI. And you can add more down here if you want to compare. So this is showing the year-to-date returns, which this is end of January 2025. So this is about 1 month of return. And you see AIPI is doing fine compared to the other two. But what I want to do is go down here and look at the total return from the date that it was launched in June of 2024. So AIPI is relatively new. And since its inception, it has returned 20%. So we're talking about 7 or 8 months so far. So you can compare it to the QQQ and the S&P 500. And if you want, you can come down here and see how since June, how $10,000 will have grown. This is the total return, counting the dividends plus the growth of the fund itself. People ask me about taxes all the time. I'm entering a phase of my life where I'm going to retire. I have 401ks, IRAs. My wife has IRAs, 401ks. We got Roth, we got regular. We have regular brokerage accounts after tax. So one thing I want to do is be predictable about what my income is going to be for tax planning. This particular fund that I have AIPI in is one that's after tax. So I'm very cautious about what's going to happen with my taxes. So right here it says the 19A1 notice. If you wonder what that is, you click on it and it opens up this page here. So there's a thing here called return of capital, and it shows $1.49. This is per share. What's happening here is that the dividends that it's paying out is actually called return of capital. Before I go any further, I'm not a tax expert. I am expert at paying taxes, but I'm not an expert at saving people taxes. I'm just telling you what I think is true. Do not take my word for it. Hire somebody, pay them a lot of money, and they'll tell you perhaps the same thing, or they might tell you something different. They might be correct. I don't know. But return of capital is technically where they pay you back part of your original investment rather than from the earnings or profits. So it's common in high yield investments such as real estate investment trusts, limited partnerships, mutual funds, and in this case, ETFs. Since it's returning the capital, basically, technically on paper, your original investment, it's not taxed when you receive it. It's not considered income or a gain. The benefit of this is that you're not paying taxes at this point right now. What you're doing, you're kind of kicking the can down the road. So if I kept this for a year and I'm earning 35%, so I sell in a year, 35% of that has been returned to me in capital. If I sell for the same price that I pay for it, I'm gonna have to pay capital gains or tax on that portion that I've already received. If I keep these forever, at some point when they've paid out the amount that I paid, so 100%, when I start receiving dividends, I'll have to start counting that income as capital gains. I'm not a tax expert at all, so don't take my word for it. So my plan is to keep these for a long time. At 35% return, it's possible in 2 to 3 years that I'm gonna have to start paying tax on this return of capital as capital gains. You can get this form. Each mutual fund or ETF has the same form. This is for the payment that was paid out in December. If I click down, this is November. Once again, return of capital. Every single month is return of capital. At some point, you're gonna have to start paying tax on that as it becomes capital gains. Let's go back to this tab. So once again, to look at that form, you click on 19A1, look for return of capital or see how that is being paid out to you. The important thing is to look at your tax documents that you receive at the end of the year. Something people are interested in is expense ratio. So expense ratio for this is 0.65%, which is seems to be about average for an ETF like this in my experience, but my experience might not be as experienced as other people. So here you have the dates when it's paid out. You can see the history. Back in July, it paid its first dividend, 48 per share. And then you can see it's very consistent. The NAV, the net asset value, hovers right around $50 a share. I've seen it range from about 48 to 52 since I've been following this. And as long as it kind of goes sideways or up a little, I'm happy with that. It doesn't have to go skyrocketing. If it's paying 35% yield, I am fine if it just kind of goes sideways. 35% total return is 35% total return, in my opinion. So the other thing people want to know is what exactly is this holding? Some of these ETFs do a thing called synthetic cover calls where they don't actually hold the shares of the stocks that it's writing cover calls on, and that's kind of complicated. I'm not going to try to explain that, but what I will explain is for this one, it actually owns the underlying stocks for this ETF. You can see that one of the largest holdings is NVIDIA, which is like close to 10%. Palantir, which is a company that's doing AI stuff, a lot of government contracts with using AI in the military. So this is really grown a lot, just been recently included in the NASDAQ 100. You could look at the rest of these. They're all related to AI companies. You can download PDF of all the holdings or Excel file. So one thing I mentioned is that for a track record, this has only been around since June of 2024. FEPI has been around for a couple years and has a pretty good track record, consistent return of 25% a year for the past several years. The net asset value has been staying pretty steady around $50, just like AIPI. By following FEPI and having confidence that Rex shares knows what they're doing, I felt confident in investing in AIPI based on the reputation of FEPI. Now, as far as safety is concerned, so these stocks here, NVIDIA has grown substantially in the past couple years. So as far as volatility, these could go up and down based on the price of these shares. So if you're worried about tech stocks and AI stocks being volatile, this might not be for you. I'm not really concerned about it. I'm thinking long term, these will continue to grow, especially for the next 4 to 5 years. These will continue to grow, but that's just me. You decide what you like to do and what you think is best for you. Let's scroll down and see what else we got. I suggest that if you're interested in this, you read as much as you can and try to understand as much as you can on their websites. Coming back up here, I suggest that you download the prospectus and read it. So, if this is the first time you've ever looked at ETFs and heard of a prospectus, I suggest that you download it, read it, look it over, try to understand what you can. Just be aware of what you're buying. Me personally, I'm not too concerned, but once again, I'll just repeat I am me and I do what's I'm comfortable with, which is maybe a little more risky than what other people want to do. I'll just add that the only reason I'm making this video is to explain what I'm doing and why I picked this particular ETF. So, as a summary, I picked this ETF for a couple main reasons. One, I love the 35% yield. Will it do that forever? I don't know. I hope it does. These covered call ETFs are kind of new. Covered calls are not new, but by having them wrapped up into an ETF like this is kind of new. Some of these fund companies seem to have it figured out, and I just assume let them do the hard work and figure it out on a day-to-day basis, and they got the experience that I don't. The other reason why I'm AIPI, which I already talked about, is the tax treatment, the return of capital. I'm not interested in paying taxes on these returns for a few years yet. So I know eventually I'll have to pay taxes on it, but I'm not wanting to do it quite yet. And then when hopefully my tax bracket drops, I'll be paying like 12% in taxes and not 22 or 24%. So that wraps it up. If you like this video, I'd appreciate it if you subscribe to the channel and give it a thumbs up.